IFRS 12 was issued as part of the consolidation suite of standards that also included IFRS 10, IFRS 11, and amendments to IAS 27 and 28. All of these standards had an effective date of January 1, 2013, including IFRS 12, which is the standard that sets out the disclosure requirements about a company's interests in subsidiaries, joint arrangements, associates, and unconsolidated structured entities. Most of these requirements are annual disclosure requirements, which is why IFRS 12 has not been an area of focus for most companies. That is, until now, of course. Annual financial reporting deadlines are just around the corner. You might be wondering, how difficult can a disclosure standard be? Well, that's a good question, and the answer will depend on the complexity of your company's interests in other entities. If your company has 100% owned subsidiaries with no associates or joint arrangements, then IFRS 12 will have very little impact. However, if your company has more complex structures and arrangements, then IFRS 12 could be more of a challenge. Here's how we see it. Like most disclosure standards, you can expect to see a list of minimum disclosure requirements. But be careful. Don't take a checklist approach to this standard and expect to be in compliance. Be prepared to stand back and assess whether the minimum disclosures tell enough of your company's story about its interest in other entities and the effects of those interests on the balance sheet, income statement, and cash flows. What should you be focused on now? Well, for starters, you'll need to consider significant judgments and assumptions. And if you're debating whether they are significant, consider this. How much time has been spent determining control under IFRS 10 or evaluating whether a joint arrangement is a joint operation or joint venture under IFRS 11? Think about it. The more time spent is likely an indicator that this is a significant judgment. As for the minimum disclosure requirements, there are a few new items you should be aware of, such as the requirement to disclose summarized financial information for individual subsidiaries with material non-controlling interests, or disclosure of significant restrictions on your ability to access or use assets to settle liabilities within the group. Companies will need to present summarized financial information for your material joint ventures and associates that you equity account, but it needs to be the amounts included in the IFRS financial statements of that joint venture or associate, not your company's share. And if you happen to be accounting for a joint venture or an associate at fair value, don't underestimate the challenge of obtaining this information. And finally, don't forget about your company's unconsolidated structured entities. Investors ought to be able to read a company's financial statements and find out if they have any exposure to unconsolidated structured entities. You have to tell your investors what the structured entity does, how it is being financed, and whether your company intends to support this entity even when it's not obligated to do so. Part of the challenge of IFRS 12 will be deciding on how to present information and whether the summarized information should be aggregated or disaggregated. This is where IFRS 12 can get a little vague. Our advice? Find the right balance between overwhelming your company's financial statements with excessive detail and aggregating so much that it obscures what's important. Listen, the fact is IFRS 12 is going to require time, effort, and significant judgment if you want to get it right. Some of this information might be difficult to obtain, which means modifying your company's information gathering systems and evaluating the related internal controls. PwC has prepared a publication that might help you understand and apply the standard. We've tried to focus our illustrative disclosures on situations where we think companies might need the most guidance. So you should check it out and call us with questions.